Now it's time for Smart Charts with Abigail Doolittle, where we look at timely topics through the charts with the street's top technicians. Abigail, I hear you're going to address all the recent volatility we've had in stocks. Good luck.
Yeah. Good point, Caroline, and you're right about that. We are going to be taking a look at the roller coaster ride that we've been having more recently for stocks, but the person who really needs the luck, David Keller of Sierra Alpha Research, thanks so much for taking the time and joining us. Fun stuff to talk about, and you have a really interesting chart here, 3 different tiers of stocks by cap size. What does this tell you?
Yeah, so when the market is doing one thing, it's always good to look one level down and start to look for confirmation, convergences, divergences, what sort of validation you can see to the overall broad market. So here we have the S&P 500 at the top, and I just point out the peak we had in late April, and then again the higher high that we saw toward the end of July before the recent sell-off. Now we have the mid-cap ETF and then the small-cap ETF, and look at how the 3 of the lines are actually relatively different. So here the mid-cap index actually never broke to new highs. So while large caps went to new highs, this actually hit a resistance level really consistently, came right back down. Small caps actually made a lower high. So the smaller the company, the more speculative, the less momentum there's been in this last push higher. That's not the sort of scenario that would lead me to expect a lot of further upside for stocks in general.
So one of my mentors back in the day, Hugh Johnson of Hugh Johnson Advisors, he would take this as a bear signal because cap size was a big part of his portfolio decisions. And I remember back in the summer of 2007, he started selling the S&P 500 because small caps started to underperform. Is that this strong of a signal here?
So I think that's sort of what we're looking at. And for me, first is the highs and the fact that we've had a resistance level and a lower high. Now it's as they start to break down through the previous swing lows. So while large caps have actually held above this low, mid caps, small caps getting very, very close, and micro caps actually have already broken down through that most recent low. So that could be sort of a leading indicator suggesting some further downside for equities.
Interesting stuff. So let's take a more detailed look at the S&P 500 and see what this out, because there's lots of, it looks like we're either right on support or...
Right. So when the market sells off like this, I would argue it's the perfect time to look at charts because this is when you can really measure people's reactions, the psychology of investors and how they aggregate. So in this case, we've had a pretty quick sell-off, obviously. Notably, the last 2 days, we've closed near the highs of the day. That's short-term, pretty constructive. But we're right at this area of support here in the 2790, 2800 range. That's the 200-day moving average. It's a 61.8% retracement of this little move here. So a number of reasons suggest that this is sort of the level at which you might expect buyers to come in. The real kicker, thinking of our previous chart, is if we would break down through that support level, if we would break down below the 200-day with some momentum, that would certainly be a potential area of concern. The RSI, the momentum became oversold, suggesting there was a real downward move, and we can see in previous oversold conditions, there's at least a little bit of a bounce, which is fair. At the bottom, we're looking at the percent of S&P names above their 200-day moving average. How many of the S&P stocks are in this same configuration? That's dropped dramatically from around 75, 80% down to almost 50%, about 60.
Super quickly, doesn't look like a capitulation bottom. Yes or no?
I agree. Not yet.